I'm going straight to the point. Today, I want to convey to you guys how you can protect yourself from any potential bank crisis or bank runs, like the bank run that we saw up into Silicon Valley Bank earlier this year. Pretty simple and nothing more than that. And there is two things that we're going to talk about. One is we will talk about what happened to Silicon Valley Bank so we all understand exactly what happened. And I understand that many of you may already know, but this is important to reiterate. And then the second thing is we're going to get into exactly what you need to do, or what I am personally doing, because I'm not a financial advisor, but what I'm doing to protect myself from potential crises like this. And so what was Silicon Valley Bank? Silicon Valley Bank was a bank that was basically focused on lending money to startup tech companies, and they were basically also incentivizing to deposit their money with them and promising them higher yields or higher interest rates. And so as these companies were depositing their money with this bank, and what Silicon Valley Bank, or SVB, was doing is SVB took that money, especially back in 2020 at the height of the pandemic, when we saw the Federal Reserve of the United States cranking down the lever on the interest rates and bringing the interest rates close to zero. And as interest rate came close to zero, what Silicon Valley Bank did at the time is they took their depositors' money and invested in bonds. It's basically a debt that you buy, and the entity from which you buy guarantees you a certain interest rate on that money for a certain amount of period, right? Basically, let's say for 5 years. And so in this case, what SVB ended up doing is they bought a bunch of short-term bonds, and these short-term bonds were bought at a very low interest rate. And so in 2022, as the Federal Reserve of the United States, which is the central bank of the United States, decided to start hiking interest rate or start increasing interest rate because they wanted to start fighting high inflations, which is translated into the price of food, services, and items and things like that. And so now what happens is you have to understand how bonds work. And so let's just take a very simple example of a bond. Let's say you buy today a bond that cost you about $1,000 at an interest rate of 2%. And let's say this bond has a maturity of 5 years, meaning that after 5 years, you get your initial investment back, plus whatever payment you are getting at that 2% interest rate. And so at this point, you're getting about $20 coupon every year until the 5th year. At the 5th year, let's say your interest rate is now 3%. What happens is the initial $1,000 is not worth $1,000 anymore. It's now worth $954. That means you have lost about $46 of its value because of the interest rate going up by 1%. And so that's how bonds work. And so in this case, because Silicon Valley Bank bought $30 billion worth of bonds at a very low interest rate, and then as the interest rate went up, they only had about $1.8 billion left in value. And so about 95% of the total bond value they had was pretty much gone. And so now you had some rumors coming from some venture capitalists saying that the bank was going to fail and telling their customers to withdraw their deposits. And as customers started doing this, Silicon Valley Bank was forced to sell those bonds at a loss to be able to cover the withdrawal. And that is a problem, because at some point you run out of money and you don't have any money anymore to cover withdrawal, and that is a bank run. And so that's what happened to Silicon Valley Bank. Now, what do you do to protect yourself from these type of things to happen to you? And so now, first thing first, there is two things that you can do. The first thing, you need to make sure that you are depositing your money into a bank that is FDIC insured. FDIC insured is a federal entity that basically ensures that any depositors from a bank that has FDIC insurance are insured up to $250,000 or $250,000 for a single person, or $500,000, $500,000 for a joint account or a married couple. And so in this case, if your bank is FDIC insured and you deposit the money there, you are covered up to that much, which is what happened with Silicon Valley Bank, where after they ran into this bank run, what happens is the FDIC came in and took over SVB. And now it's in the end of FDIC, and the Federal Deposit Insurance Company will now try to look at ways they can recover some of the money and being able to pay back the depositors their money. And so this is the first thing that you need to do. The second thing is, I remember seeing a video from the Secretary of Treasury, Janet Yellen, and she said something very interesting. She said that any bank that poses a potential systemic risk, meaning that a bank that collapses that would have major ramifications on the US economy, that bank will be bailed out. And so what I would do is I would move my money out of local banks into bigger regional banks, because those actually have systemic risk, potential of systemic risk. That is the first thing. The second thing is you need to own an insurance policy. You need to own gold and silver, precious metals. And then later on, we can go into digital assets such as Bitcoin and Ethereum. But in this video, I'm only going to focus on precious metals. Guys, I personally invest in precious metal, not only the physical metal itself, but I also invest in companies that produce them. So in stock of companies that produce gold and silver. But then now, the big thing that you really need to understand here, why am I saying gold? Especially the physical gold that you really need to have before even buying the stock, is because this is not in the hand of the banks. This is going to be in your hand. And for example, I used to live in the state of Utah, and in the state of Utah, gold and silver are considered to be legal tender. That means you can even pay taxes with gold. But the reason here is just that because these precious metals tend to preserve the value over time. And that's what you need to do, but not just preserve the value over time. They also tend to increase in value in times of turmoil. And I have an example for this that I want to share with you guys today. So I am subscribed to this service called Silver Chartist. But basically here, this is the price of gold, and it's showing that when Silicon Valley Bank was collapsing, gold was trading at about $1,820. And then by the time the FDIC, the Federal Reserve, and the Treasury made a joint statement saying that they were going to step in and bail out the depositors, that they were going to give all the depositors their money back, and not only up to $250,000, because most of those depositors had their money not insured, right? And so now you can see here that the price of gold went up to $1,900, right? Why? Because investors were taking the money into other things and putting into gold because it is a safe haven. So guys, this is the first thing that I wanted to show you. The second thing that I want to show you is this chart of just over a lifetime of basically when we've had some type of financial crisis. In 2008, 2009, we had a financial crisis, and this red curve right here is the amount of money that the Fed pumped into banks. And you can see here, with the amount of money being pumped into banks, you can see gold increasing. And then now in 2023, money being pumped again back into banks, we're going to see this increasing. In 2020, somewhere around here, money was pumped into banks. We saw gold also increasing. And so guys, there is a pattern here of being able to not only store value, but also potentially being able to make some extra money on top of it. But then now the question you would have is, which one do you own? Do you prefer to own gold? Do you prefer to own silver? And the way that I look at it is I use what is called a gold to silver ratio. And a gold to silver ratio, it's basically just the price of gold divided by the price of silver. And it gives you a number. What does this number mean? Right now, the gold to silver ratio is 79. At 79, it means you with 1 ounce of gold, you can buy 79 ounces of silver. That is what this means. And so when we look at this data over a longer period of time, let me go back on the weekly chart. So let's say in 2011, the gold to silver ratio was at about 31. That means you would only need 1 ounces to get 31 ounces of silver, which is much less versus now. And in 2020, at the height of the pandemic in like March/February, we can see that this ratio even reached like 126, right? And so at this point here, that means silver is very much undervalued versus gold, because with less gold, you're able to get more silver versus less gold and being able to get less silver. And this is basically what it means. And looking at this chart, what it tells me is I actually am much more invested in silver and then less invested in gold. And as this gold to silver ratio is going to be shrinking over time, the closer it's going to get to 30, then I'm going to be pretty much converting my silver into gold. So my silver coins into gold coin, my silver stocks into gold stocks. That is pretty much, guys, what I am personally doing to protect myself. I'm keeping it very simple. I own physical gold, physical silver, gold stocks, and gold and silver stocks. Very simple, guys. Nothing crazy, just an old formula of storing wealth and potentially gaining some more wealth as well. I hope that I provide you with enough value in this video, and later on we're going to talk about how you can also use digital asset like cryptocurrency to also protect yourself. But today it's precious metals only, and thank you for being here, and I'll see y'all in my next video. Bye bye.